let's do a case study, if you will. So we've got an idea, and then we can apply some of these strategies. So let's meet a hypothetical woman named Jane. So Jane is 76. Her husband passed away about 2 years ago. She's in good financial position. She's living on Social Security, her husband's pension. She also inherited a large traditional IRA. And now this is combined with her IRA. So again, the goal, Jane is retired and financially comfortable. Her required minimum distributions now are quite large, which adds a significant amount to her taxable income, something that we see quite often, Kyle. And so she also happens to be very charitably inclined and wants a meaningful gift of $25,000 this year to her local zoo and help them build a new exhibit. So here's the default, right? So we're going to do a little bit of a case study. Here's the default. So Jane's first instinct is to pull $25,000 from her IRA, have the taxes withheld, put the rest in her checking account, and write a check to the zoo. Kyle, what's wrong with this?
Yeah, so the taking that out of her IRA directly to herself, that does, one, we created a taxable event there. So because it came directly to her, yes, so we are paying tax on that. That is included in her adjusted gross income, which depending on what her Social Security, maybe your pension, plus the RMD. I mean, then we have a possible IRMA situation, which is an additional Medicare surcharge. So strike one there. And then on the deduction there, she's given $25,000. Yeah, it's enough for the standard deduction or the itemized deduction as a single taxpayer. But at the same time, we have income on page 1 of your tax return, your income. Then we have the deduction on this side. So it's like a tax wash, right? We're not saving it. There's no benefit to Jane from doing there.
Yeah. So let's revisit that. So to your point, so she's already receiving pension. She's already receiving Social Security. So by taking this, and then mind you too, one thing we probably didn't talk about a whole lot is, and that happens quite often, which is why tax planning is so important, is she's going from a joint filer to a single filer. Mm-hmm. So she's going to accelerate through the tax brackets quite rapidly. She's going to get half the standard deduction. And so this could have monumental effects on her. So to your point earlier, so she's going to increase her AGI, right? Mm-hmm. She's going to withhold taxes on the distribution, meaning that $25,000 gift is now going to be less than that. And to your point, she might have to pay extra Medicare premiums next year as a result of this. Yeah, this is not a wise strategy, but Kyle, this is not something out of the ordinary, right? We do see this of people coming to us, and this does happen, right?
Oh, yeah. Yep. All too often.
Yeah. So what we want to talk about is one of the ways that we just talked about is perhaps an alternative route to that might be a lot easier is donating appreciated stock. So the alternative, the first alternative, Kyle, that I want you to consider is what if so let's say hypothetically she has a taxable account. Maybe it's a brokerage account that she had with her husband. And let's say she's got $25,000 worth of stock that she bought 20 years ago for $5,000. Yep. So great appreciation there. Great investor by the way. And then she could donate the stock directly. How would that monumentally change, from the first scenario?
Oh, sure. Yeah. We're just donating the stock. We're not recognizing any income to her. We're not taking an asset that has ordinary income impacts to it, attributes to it. And so that's not even it's a moot point there, I guess. So we're not cashing out the IRA to do that. The donating the stock is now more tax efficient just because now we can give away an asset that has the capital gain. I don't have to sell that and recognize the capital gain, and I'm still getting a deduction for it at my fair value, not the cost basis. So it's like that gain doesn't even exist when it comes to donating that piece of stock to the charity.
Nope. So great point all the way around. So let's compare that to how it happened the first time. So by donating appreciated stock, she's not increasing her AGI by increasing taxable income. She's not increasing her IRMA premiums potentially. And the charity is getting all $25,000 of the donation. And on top of that, she's not having to realize capital gains when she sells that stock and donates it.
Correct. Absolutely.
Okay. So not a bad strategy to consider if that somebody is they have appreciated stock, maybe they have RMDs and they're using their RMDs for their lifestyle and they want to donate to charity. This would not be a bad option.
No, nope.
What I want to consider
Yeah.
now, Kyle, is perhaps my favorite option. I don't know about you, but now it's
Mhm.
it's the QCD, the qualified charitable distribution. So
Mhm.
walk us through. I know we've talked extensively, here on the show about what a QCD is, but Kyle, let's talk about first about what a QCD is, and then let's see how it relates to Jane in her scenario.
Yeah. So QCD is short for a qualified charitable distribution. And that allows a person who has an IRA, if they're over 70 and a half, they're allowed to take a withdrawal from that IRA directly to the charitable organization. It is a non-taxable event. So what I mean by that is when it goes directly to the charity, you don't it's not included in AGI, it's not included in income. But on the flip side, there's no tax deduction. It's as if an IRS's eyes, like it didn't exist. It's like a transaction that is not reportable. It's reportable, but it doesn't affect income in any way, shape, or form to you. Versus taking it directly to you, putting it in your bank account, then writing a check to the charity or the zoo in this case. Then we have a taxable event along with a deduction. So not as efficient by doing it that way, but the qualified charitable distribution would be the most efficient way here.
No, I completely agree. And my favorite part is that it satisfies the RMD. So let's say,
Correct.
she's at a lifestyle now where Social Security and pension are covering most, if not all, of her lifestyle. And not to mention, it sounds like she had a brokerage account she could dip into if she needed to. But, what the RMD forces a lot of people sometimes into those higher tax brackets, those Medicare surcharges. And so something like a qualified charitable distribution or a QCD is my favorite because it goes towards that RMD. To your point, it's not taxable and really checks a lot of those boxes. And Kyle, it surprises me how much we talk about this and how much people you would think are familiar, but we still see it time to time. I actually had a client of mine, I had to re-talk her into it. She was donating unbeknownst to me, and we looked at her tax return and I had a conversation. I was like, why don't we use QCDs? And it sounded like something was we were pulling, the eyelids over her eyes to say, hey, here's a dirty trick. And it felt wrong to her, but we showed her all the benefits. And she goes, she walked away very impressed. And this has been a client that's been there for 10 years, but she wanted to do it. It was an old habitual thing. And we had to talk her out of it. And this is somebody that we had an incredible amount of trust with. Again, it was something that our CPA sat in on it, but it feels wrong in a way, Kyle, but yet it is one of those that is the most powerful strategy for a lot of reasons. And again, when it makes sense, but I would completely agree with you here on the QCD. Anything we want to wrap up on the QCD before we switch topics here?
Yeah, and then just to reiterate, I know a lot of times people will say, "Oh, I'm not RMD age yet. I can't do a QCD." So no, that is not the case. You only have to be 70 and a half, not the new 73. So that's very, very important to understand. So you do not have to be RMD age to be able to take advantage of the QCD.
Yeah, that's a great point, Kyle. We have to go back in the day when RMDs used to start at 70 and a half. And then once the year passed, charities kind of raised their head and said, wait a minute, if we start, what was back then, the RMD age is 72, now 73. Charities are saying, wait a minute, a lot of these people like to use QCDs, and the IRS, your point exactly, said, hey, we can maintain the 70 and a half for the QCD. So great point. If you are 70 and a half and you're charitably inclined and you're not needing your IRA, again, a QCD can be a very, very powerful tool. The only other thing I would like to add to that, Kyle, too, is to keep in mind that QCDs can go up to $100,000.
Yes.
So, or actually, I should say that
108,000.
OB3, excuse me, is that I stand corrected. Is you want to talk about OB3 and its effects on QCDs? Thank you.
Yeah. No, they're indexed for inflation now, which is good. And now for this year, it's $108,000. So, and then once again, that's per taxpayer. So a married couple, if they are very charitably inclined, have large IRA balances, you could possibly defer up to $216,000 out of their IRA into a charitable organization. And with the new cost of living adjustments now going forward, so that could be some material givings going on to be able to take advantage of some major tax benefits there.
No, that's great stuff, Kyle. That's great stuff.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.